So this video, I'm going to go over the exit planning for small to mid-sized businesses. I want to cover how you prep your business for a sale, whether you are looking to really hit the market in 3 months, 6 months, 1 year, up to 3 years. This will apply to any timeline, but the goal around everything in this slideshow, in this presentation, is to show you how to properly get everything ready in your business. And the topics that I touch on are topics that will help maximize your asking price for your business. So a lot of this is going to be from the perspective of a buyer, putting yourself in the buyer's shoes to see how they look at businesses or value businesses. So my goal here is to hit on some major key things that buyers are looking for, all types of buyers, right? What they're looking for in any sort of business acquisition that they're doing. So this will help you plan for an exit. But if you do all of these items in here that we cover, it will really help you demand and stand behind the higher end of that asking price for your business. So I'm going to make myself a little smaller here, put myself down in the corner. If you don't know, my name is Jordan Kelleher. I am the founder of Kelleher Acquisitions. We are a business brokerage in Austin, Texas. We work nationwide. A lot of our deals are done in Texas, though, as you can imagine. Just a quick background on me. I won't bore anyone too much on it. I grew up in St. Paul, Minnesota, ended up moving to Dallas. I accepted a position at a smaller boutique firm in Dallas as a business broker. I had the opportunity to work deals from start to finish. A lot of these major firms, you tend to be on a team that gets to see a little slice of the pie of a deal. I was grateful enough to be able to work the entire deal. By the time I left that firm, I had closed the largest deal at that firm, and I was leading about 80% of the deals at that firm at that time. I ended up moving to Austin with my girlfriend, where we are right now, and started my own firm where I am now helping business owners exit their business. So I touched on a lot of this. I do want to keep moving on to get into the meat of everything here. So what is the importance of exit planning, right? And why we want to do this is, one, to attract more buyers, but we want the highest offer price, right? There's no secret to that. I talk to business owners all the time from a variety of size ranges in the business, and they all want the highest price, and I understand that. And they want the smoothest process, but they also want their employees taken care of and their clients taken care of, and those are all very, very important aspects. A lot of times there's family members that work at this business, but we have to put proper exit planning in place before we go to market, before we engage even someone like myself, although I will help you with this too. But it helps reduce risk or red flags for buyers. So that is the objective of exit planning, is to find all of these potential threats that buyers could view as threats and get them out of there and remove them, or at least bring them down from where they are currently. We want to make it as appealing as possible. And there are a handful of things that will make your business very appealing that we can tweak throughout our exit planning process. So it significantly increases your odds of selling your business when the time is right for you. So this can be implemented at any point, at any point in your business, as long as it's done before you go to sell. A really big thing that I see a lot that just kind of bums me out, honestly, is when a business owner is around retirement age and they want to sell their business, and they've done none of this, and they didn't know they had to do any of that. And so I understand, but they want to sell for $3 million, and they probably could have if they took a year or two to put all these things in place. But the realistic market value of their business is around 1.5 to 2. So it really truly can. I don't like to just say this, but it can save you hundreds of thousands, if not millions of dollars, if done properly and you prepare before you sell your business. And why do I say that? So the percentage of businesses that successfully sell is around 20 to 30%. And so what that means is that all of these people who are exiting their business, retiring, simply wanting to cash out, most of the times have a very difficult time trying to sell their business, trying to find a buyer to pay them what they're asking for, right? And that is for a variety of reasons, but I wanted to put some statistics in here so you can see. Now, these are estimates from some large firms out there, but if you go to websites like BizBuySell or BizQuest, these are essentially the Zillow market for businesses. And if you keep your thumb on the pulse of your city or a specific market for a few months, you'll start to see that you will see the same listings over and over sitting on that platform for several months. And we don't want to do that, right? And so a good investment banker or a good business broker sometimes won't even list on these platforms because they have a big buyer pool that they can bring your business directly to. That's my goal at our firm. I like to keep a lot of our listings off market, but that also means that the business has to be ready to go to market. And so that's why this exit planning is so important, because you can't have a few things out of line or out of order and then keep it off market to go to a buyer, because they're going to have some concerns. And then maybe you need to open it up to a broader range of people and list it on those listing platforms. So that's why, again, this exit planning is so important. It increases your odds. So right now the odds aren't the best, but I will also say not a lot of business owners do proper exit planning. So this should be an eye-opening enough statistic to push you in the direction of doing some proper exit planning before you sell your business. So I'm going to touch on a lot of these. The red ones that I have bolded and highlighted here are usually going to be the real important ones that we want to focus on. So I will go into each of these red ones, but here's a list of why majority of businesses do not sell. So as you can imagine, unclear financials and poor record keeping, overinflated asking price, unrealistic seller expectations, which happens a lot, and I'm sure you probably don't want to hear that. Hidden liabilities in the business, dependence on the current ownership of the business. So again, I'm going to touch on these ones in red. But number 5, market or industry liability, lack of transition plan, inability to secure financing. This would be an issue on the buyer side, but it does happen quite a bit. Cultural or personal misalignment, that is another common one. Poor reputation or customer base, something like your Google reviews aren't very good. That can deter a lot of buyers. Customer concentration being over 25% and not growing year over year. So again, these aren't 11 things that you absolutely 100% must have in order to sell your business. You can still sell your business. These 11 things are going to allow you to stand behind the high end of your asking price. And that's the goal, because like I was saying earlier, this really is going to be the difference between a few $100,000 or even $1 million or $2 million when you sell your business. And I know it sounds like a big number I throw out there, but it's the truth. It's the honest truth. I've been a part of so many deals where I've seen sellers be able to demand that price and get it. And I've seen situations where they wanted a certain number and it was almost cut in half because it was just, it wasn't organized properly, I should say. So a valuable business will sell in any industry, in any market condition. So what makes a business valuable? And this is kind of what I was saying on that last slide, is that if you have all of those 11 things, most importantly, those ones that I highlighted in red, it doesn't matter too much what industry you are in. It's a valuable business. And I'll touch on why I'm saying it's a valuable business, because again, if we jump into the buyer's shoes, they see value if you have those things in order in your business. So if you can get them in order, no matter what industry you're in, no matter what is happening in the economy and the market, these businesses will sell time and time again. And the reason why is because, yes, when interest rates go up, it makes it hard for people to use financing and SBA loans, but there are so many different types of buyers, strategic buyers, financial buyers that we will go over, that are sitting on dry powder. They're sitting on cash. They have to use this money to buy investments and to buy assets. And so they tend to buy when market conditions get a little crazy. So before we define a valuable business, we have to look at who the buyers are. So this is what I want to touch on. See if I can get my head out of here somehow. I'll just put it right here for a minute. So there's two types of buyers. You have strategic buyers and you have financial buyers. The strategic buyers come from the same industry, or they spot synergistic benefits of acquiring your business. And so what I mean by that is I'll just use a plumbing business, for example. If you own a plumbing business, a strategic buyer may also own a plumbing business, right? They own a business in the same industry, or they own maybe a manufacturing business or a transportation business, a business where they see if they acquire your business, it almost immediately helps them day one. There's synergistic value that they see in your business, right? It either helps them expand geographically. Maybe they're buying your business and it's in the neighboring state, the neighboring city. So they're expanding geographically. That's going to help them tremendously. Or it gets them closer to the suppliers or the vendors that they need, or it gets them closer to a customer base, right? So if a shoe store business is trying to sell, and then there's the manufacturer of shoe soles or rubber, that shoe store may buy that manufacturer because it gets them closer to vendors and suppliers, right? Or they buy another shoe store in the state across because it helps them expand geographically. So strategic buyers, they tend to think a little bit more long term, and they tend to pay a little bit more because they see the benefit in your business and they think further out, right? They're still going to look at your financials. They're still going to comb through them and put it under a microscope, but they tend to see the benefit in other areas, not just in the financials, not just in your profit and loss statements. Now, the one thing with strategic buyers, this isn't always the case, but this last one down here, they might not need to retain all personnel from your business because they typically have management in place, an organizational chart in place. They have employees there. So if they have an HR department and accounting department and they buy your business and you also have that, they may not need to double up on all those different departments. Now, again, that's not always the case, but it's going to be more likely with a strategic buyer than it will be with a financial buyer. So it is something to keep in mind. I always encourage sellers, if we are dealing with strategic buyers, it's really important to go out to lunch, have several meetings and calls, and find out, well, hey, what's your plan with the business here? What's your plan with your employees? I'm going to guess that you really value and care about your employees, and so you want to protect them, especially if they're family members, they've been there for a long time, right? You want to protect them. So you really want to find out what the plan is in terms of operations and organizational structure and charts within that business or the merge of what is going to be the plan with these employees, right? A lot of ways around that. You can do employment contracts, but it is something to keep in mind when you're dealing with strategic buyers. Now, when you're looking at the financial buyers over here on the right-hand side, these are more of a wider range of buyers. So you're looking at now private equity, individual entrepreneurs, search funds, independent sponsors, family offices. These are all financial buyers. And they're going to put a heavy focus on your financials because they're looking for a return on their investment, right? They're looking for that ROI. So they're going to really put a big emphasis on what your profit and loss statements look like. What do your balance sheets look like? What do your tax returns look like? What do the cash flow statements in your business look like? Because their goal is to get a return on the money they put down. It's the same goal that the strategic buyers have, right? But the strategic buyers also are looking for other synergistic benefits to their business in terms of, like I was mentioning, geographical expansion, closer to the manufacturer or the customers. Whereas the financial buyers also, that's of an importance to them, but they're looking for a return on their investment. They tend to think more around a 10-year timeline because they're going to buy a business that is growing, that is cash flowing, and they're going to try and build it up a little bit, and then they're usually selling around a 10-year mark. That's because that's usually when the long term comes to completion on a lot of these business acquisitions. I will say in the last thing here too, this last bullet point, I should say, they actually do the opposite for the most part. They will look at who your management is, who your personnel is, right? Because they are going to need them, and they are really going to need to lean on you and your team. And so this is when transition periods might be asked from you as the owner. They might ask that you hang around for a couple months to help them with the transition. They're really going to vet who these key personnel in your business are to make sure that they can really lean on them and continue growth in the business. So this is that's going to be a heavy importance. and I would say a majority of buyers are financial buyers. So you really want to have clean financials, which we'll touch on here shortly. And then you really want to have a good organizational chart, good management team, because that's what makes it more attractive for these type of buyers and strategic buyers. I'm moving my head all around here. So how strategic and financial buyers see value. These are the red items that I highlighted. Outside of no legal issues, I felt that was important to still put in there. And I'm going to go in on all of these in these next few slides. But how they see value or perceive value in a potential business acquisition, they're looking for good cash flow for a minimum of 3 years. They're looking for clean financials, profit and loss statements, balance sheets, tax returns. They're looking for a business that's not dependent on the owner. They want to see strong management team or an operator or operators. They are looking for customer concentration to be 20, 25% or lower. And then obviously no legal issues within the business. Some bonuses are contracts. If you have contracts with your customers, suppliers, or vendors, reoccurring or reoccurring revenue, meaning if you've got subscriptions or contracts in place, or if it's something where customers just come back on a regular basis, that's not necessarily a subscription, right? Think landscaping. If I cut your grass, you're going to need me to come back in 2 weeks to cut it again. So structures like that are also very valuable. And then any documentation or SOPs, standard operating procedures, contracts, document. You want to have documentation on everything within your business. Here's what we do when this happens. Here's our SOP for this. The more documentation you have, the better. So the first thing, cash flow and business earnings. So for the most part, businesses are bought and sold for a multiple of what they earn. And that earnings metric that we use is either going to be EBITDA, which is your earnings before you pay interest, taxes, depreciation, and amortization, which I'm sure a lot of people have heard of, or SDE, which is seller discretionary earnings. And so we want to be able to show 3 years of steady growth on the last 3 annual profit and loss statements and your tax returns, right? So buyers are looking for stability and consistency. And to touch back on the earnings metric. So when I say businesses are bought and sold for a multiple of what they earn, for the most part, if your business is earning $500,000 to $1 million in bottom line earnings, you're usually going to see $500,000 to $1 million and less. Excuse me. You're usually going to see seller discretionary earnings as the metric that's being used. Some people say cash flow. What's the cash flow of the business? What's the SDE of the business? And then once you get over $1 million in earnings, sometimes people will still use this even down in the $200,000 earnings. But once you get over $1 million, that's usually when you start to see the metric of EBITDA, right? So kind of essentially the same thing of measuring the profitability in your business, right? So again, EBITDA is the business's earnings, that bottom line, before you pay interest, any bank debt, taxes, depreciation, and amortization. And SDE is seller discretionary earnings, which is the net income of your business and any ownership compensation. So if you pay yourself salary, distributions, or any discretionary spending within your business, if you're running your personal car through the business, your personal phone through the business. I've seen country club memberships ran through businesses as well. So all of that can be added to the net income, and that's called the SDE. And these two metrics are used for buyers to compare different businesses, right? If I'm looking at 5 different medical spas that I want to buy, it's hard to compare 5 different businesses and all these different moving parts. And so the EBITDA metric was created to calculate a number that I can compare to the other 4 businesses and go, okay, this EBITDA is $1 million, this EBITDA is 1.2, this EBITDA is 1.3, this EBITDA is 950. So that way I can compare them. And it's not all just about the number, the highest number, but it gives you a better sense of the cash flow within the business, the profitability of the business, excluding things like depreciation and taxes and amortization, right? So that is the earnings metric. And then once you have calculated that, let me back up, because you want to take that metric, and businesses are valued. It's kind of a Wild West system out here, right? But businesses are valued for a multiple of earnings. And let's say your business is $1 million in EBITDA. That EBITDA is the earnings metric. So what multiple do you apply to that? Now, for the most part, industry standard for almost all industries is between a 3 and a 4, 3 and a 5. But when your earnings, that EBITDA gets around $1 million and starts to go up, that's when you see that multiple start to creep up a little bit more, depending on the industry you're in. The industry can actually change the multiple quite a bit, right? But the main driving factor is going to be how big that number is. So if your EBITDA is $1 million, probably going to be closer to a 4 or maybe even a 5, depending on the industry, maybe a 6, right? And so I like to take the last 3 years of your profit and loss statements and find the EBITDA for all 3 years, take an average of that, and then apply a multiple. You can also weight certain years. Maybe you're going to weight 1 year a little bit heavier because you perform better, but just know that buyers are going to look at it from the other perspective. They're probably going to try and average it out and even it out a little bit more, and then you apply a multiple to that. For easy math and easy numbers, let's just say it was $1 million for all 3 years in a row. Apply a multiple of 4 or 4.5. Maybe you apply a 5 if you're in a high demand industry, or a 6 in a higher demand industry. It's not uncommon to see it creep up to that 6 range if you're in a pretty high demand industry. But that means your listing price is $4 million, $5 million, maybe $6 million, right? So that's how you come to the valuation of your business. Now, there are a lot of other variables that come into play here in terms of other tangible, intangible assets in your business. Maybe there's real estate involved, any sort of goodwill or IP. So that is not just how you run a valuation. There's a lot more that goes into it, but it is a good back of the napkin approach to see where you might fall in terms of what is your business worth, right? Lastly, large dips should be justified. So if you're looking at your profit and loss statements and I'm a buyer and I see a big dip in revenue or maybe cost of goods sold, any line item that has big fluctuations, there should be some sort of justification backing that up in terms of, was it a large investment? Did you have legal fees that year? And then the flip side as well, large increases should be justified, right? Why did revenue just go from 1.5 million to 3.2 in a year? What just happened there? Because as a buyer, I need to know that, well, do I need to sustain that 1.5 or can I expect 3.2? Like, what just happened? What was that? So you should be able to go back and point to, well, we signed a new contract, we signed a new client, or we opened up a new product line, right? So you should be able to justify these big fluctuations within your profit and loss statements. If you can't, it causes a little concern for buyers. And so really, if you can just have consistent growth, whether it's 10%, 15%, 5%, just consistent growth for at least 3 years, you're going to be in a very good position. To maximize your value, your asking price, wait until you have 3 full years showing growth. This may require 1 to 3 years to get in line. I'm actually glad I put that in there. And that's the whole part of exit planning, right? If you have a down year 2, right? Year 1 looks good, year 2 was tough, and then year 3, you're back on trajectory. It is worth it to take 1 to 3 years until that one down year is pushed out from the last 3 years, if that makes sense, right? Now, this is how you can maximize the exit price when you sell your business. Now, I'm not saying you can't sell if you have a down year. You absolutely can, right? And you probably will get offers. But that year is going to push your price down a little bit. So that's why it's important to do this early on before going to market, because this can really help increase the value of your business. Number 2, clean books and financial records. So this is so important. So important. Hopefully no one's doing bookkeeping in their own Google Sheets. I've seen it a lot actually from bigger businesses. But you want to have organized and clean financial records, meaning your profit and loss statements, your balance sheets, and your tax returns should be organized, clean. Have an accountant do it, a bookkeeper, CPA. Have somebody taking care of your financials for you, right? Where you can easily go into QuickBooks or whatever software you're using, where you can print off your profit and loss statements. And then you can print them off in different formats too, because you will need to do that. Trust me, a buyer's going to come in and say, I want to see a monthly breakdown for 2023, right? Or please send me year-to-date financials throughout 2025 now. So you need to have organized, clean financial records on every category with it, that is tracking finances in your business. Sloppy or hard to read records can lead to buyers walking from a deal. Track personal discretionary spending inside the business with clean and justifiable line items. So these are called add backs, like I was saying earlier about if you're running your personal car through the business or your personal phone through the business, that's fine. But we need to be able to go to the line item on the profit and loss statement and say, oh, these are personal spending. This is discretionary spending. So we can take that amount for the year and we can add it to that bottom line, right? So it's okay. We just need to be able to point to it and add it. And those are called add backs. Clean books will save you weeks of headache and stress when it's time to sell. Anything less will raise an immediate red flag. It's very true, right? Buyers want to see clean, organized financials. If you don't have them, it will cause a little bit of concern of why it's taking so long to produce these financials outside of people's schedules being busy. You want to be able to pull these records fairly quickly, and they want to be clean. And if anything is unorganized, it just causes concern. I have been a buyer to a deal before where the business was great. It was cash flowing everything was checking my box. And then we get into the due diligence phase of the transaction process, and the books were just a little messy, and the business owner didn't really know why numbers were here and there. And I by no means thought he was lying or trying to hide anything. I was just concerned at how unorganized it was. I didn't know if he was unaware of certain things within his business, and for that reason, I had to walk away from the deal. And so I'm trying to give real life examples of how something like having a little bit of sloppy financials can absolutely blow a deal. And for that business owner, for that seller, it blew his deal. That was the reason I walked away. It was too unorganized. It concerned me. And in the back of my head, I'm like, is there something else that he's missing that he just isn't even aware of? I think he's being truthful, but does he not know about something where now if I buy it, it's going to be a surprise, and I don't want to buy surprises, right? The third one, owner dependency. This is a really, really big one. I've unfortunately been part of deals as a business broker where this has really gotten in the way, and it was really, really sad and unfortunate to see. But is ownership heavily tied to revenue generating operations or customer/vendor relationships? Now, I always ask business owners, could you take a 6-month vacation without revenue dropping or the relationships fading away with customers or vendors, right? Would customers be calling you in a panic because you are not there at the business? And so buyers are looking for systems. They're looking for well-oiled machines. They're looking for management in place. So if we remove you or the ownership team from the business, what happens? What happens to the business, right? And so put yourself in the buyer's shoes again. If I'm going to buy your business and I pull you or whoever else is part ownership of the business out of this equation, what now happens to the business? If revenue starts to drop immediately because you're going out the job sites, or you're the one bringing in all the revenue, or you're the one who has all the relationships with the manufacturers, the customers or clients, I need to fill your shoes, and I can't fill your shoes the way you fill your own shoes, right? And so I'm not saying that buyers are looking for something where they don't have to do anything at all, but it can't be too heavily tied to all of this revenue coming in, where if one or two people leave, the whole business goes away, right? Because that is very concerning. And so you want to put a heavy emphasis on having key personnel there, having a manager, having an operator, having department heads if cash flow allows for all of that, right? But it is really important to groom somebody to essentially have a CEO role within the business that's going to stay there. Um, I'm thinking of a business again. This was another business that I had looked at, and I had tried to help him sell the years prior, and they have a really good business, revenue over $1 million. They had almost 35% profit margins, doing a really good job, right? But a lot of the revenue is tied to the two owners of this business. And so I tried to advise them, hire a CEO. You have the cash flow to pay 6 figures for someone to come in here and manage and run the daily operations. And so he ended up doing that. And obviously, as you can imagine, cash flow dipped a little bit, but it allowed them to remove themselves from the business, let things even out. It took a year and a half, 2 years to do it, but it made his business, their business, so much more attractive, because it wasn't relying on those two people, right? So you really want to look at your situation and see how reliant the business is on you or ownership of the business. So could you take 6 months off, and what would happen to the business?